What if I told you there is a situation where property investors can legally pay very little or even nothing in stamp duty? Not through dodgy loopholes, not through complicated tax schemes, but simply by understanding how HMRC classifies different types of properties. Hey, I am Rahimba. I started investing in property with no experience, no money, no connections to building a multi-million pound property investment portfolio. Along the way, I've been featured by the BBC, Business Insider, magazines, national newspapers. I've also helped more than 2,000 professionals begin their property investment journey. Many have gone to become full-time property investors and become financially free. If you're new here, welcome to the Success Blueprint. This is where we talk about property investment, wealth creation, financial freedom, mindset, and personal development. So if you're serious about building your own blueprint for success, hit the subscribe button and join the community. In today's video, I'm going to show you how experienced investors approach derelict buildings, commercial properties, mixed-use properties, and commercial to residential conversions. Most importantly, I'm going to explain how the classification of properties could significantly affect the amount of stamp duty you pay. Look, if you cannot invest 10 minutes of your time to learn how to pay no tax when you buy investment properties, I'm afraid you're not going to make it. For the few that are interested, let's get started. Look, most professionals focus on one thing when buying an investment property: the purchase price. But experienced investors know the purchase price is only the beginning. You also have legal fees, refurbishment costs, finance costs, survey and valuation fees, and one of the biggest upfront costs of all, stamp duty. Get this wrong, it could wipe out a significant part of your profit before you even collected the keys. When I first started investing in property, I thought finding a good deal was enough. I focused on buying below market value properties. I looked at rental income, monthly cash flow, capital appreciation. But as my portfolio grew, I realized that sophisticated investors look beyond the purchase price. They understand the tax implication and they understand how to buy more intelligently. One of the biggest lessons I learned was this: two properties with same £200,000 purchase price could have completely different tax outcome depending on what you are buying and how the property is classified. That's why understanding stamp duty could potentially be worth thousands of pounds. Let's look at the 5 strategies and opportunities you need to understand stamp duty. 1. Buying genuinely derelict property. This is where investors become confused. You see, a lot of people believe that any rundown or uninhabitable property automatically qualifies for lower stamp duty rate. That's not true. There is no automatic stamp duty exemption simply because property needs significant renovation. A property that needs rewiring, a new boiler, damp treatment, new windows, a replacement roof, or a new kitchen and bathroom will still be classified as residential. The threshold is extremely high. The property generally needs to be genuinely unsuitable for use as dwelling at the time of purchase. Look, we're talking about circumstances such as severe structural damage, missing floors or staircases, major fire damage, serious safety issues, or building that has effectively lost its character as a home. Think of an abandoned farmhouse, a fire-damaged cell, or a building suffering from structural collapse. Not simply a tired buy-to-let with an old kitchen and a broken boiler. This distinction is extremely important because getting the classification wrong could lead to additional tax, interest, and possible penalties. So always check those boxes. 2. Buying commercial property. This is a strategy many experienced developers use. Commercial property is generally taxed differently from residential property. This includes offices, shops, warehouses, former pubs, retail units, and certain other non-residential properties. Commercial and non-residential properties are normally assessed under non-residential stamp duty rules rather than standard residential rates. For example, imagine buying an empty office building. Instead of competing with dozens of residential investors for another standard buy-to-let, you are buying a commercial asset with potential to be transformed, which you may then be able to convert that office into apartment. You are not only acquiring a property, but you are creating an opportunity to increase its value before the first tenant even moves in. in. Sorry for interrupting this video. I just wanted to draw your attention to a guide I've just created. This guide is for you if you're looking to start and scale in property investment and you've got questions that you want to ask in order to start your property investment. This guide is the ultimate guide to start and scale in property investment journey. I talk about the different type of investment strategies. I also discuss the 11 ways you can raise finance to make any property no money down deals and the type of properties to buy in order to generate a serious return in your investment. And I'm giving this book away for completely free of charge, no string attached, nothing, absolutely free. Click the link on the description of this video to get your free guide now. We've only got a limited number of these copies available as well, so click the link to get your guide now. Let's get back to our video. 3, I love this one, commercial to residential conversion. This is where some of the biggest property profit is created. This strategy can look like this. You buy a commercial building, you secure the necessary planning permission, you convert that building into multiple residential accommodation, you increase in value, you refinance it, you rent it out. Some instances you recycle all your money and then you repeat the process again and again. This is the key. The key is to understand that you're not only buying the building for what it is today, you are buying it for what it could become tomorrow. But the figures must still work after you account for planning, construction, finance, professional fees, and risk of delays. 4 is a biggie. Mixed-use property. Mixed-use property is one of the most overlooked opportunities in property investing. Example, a shop with a flat above it, a cafe with an apartment upstairs, an office with a residential accommodation, or a building that combines retail and residential space. Listen, I'm talking about a genuinely mixed-use property may be treated under non-residential stamp duty rules rather than standard residential rate. And that could create a significant difference in the amount of tax payable. But the property must have genuinely non-residential and residential elements in it. You should assume that a property qualifies for simply because it was previously used for another purpose. The actual use and condition of the property at the time of purchase matters. So do your due diligence to ensure you know what the status of that property before you buy it. 5 is going to shock you. Focus on value creation, not just tax savings. This may be the most important point in the entire video. Never buy a property simply because you believe you will save money on stamp duty. Buy it because it is a strong investment. The tax savings should be a bonus, not a reason for doing the deal. Look, I've seen investors become obsessed with saving a few £1,000s in tax whilst completely ignoring opportunities that could generate tens or even hundreds of thousands of pounds in profit. Here's the deal, stamp duty is only one part of the calculation. You still need to consider the purchase price, the refurbishment cost or conversion cost, planning risk, finance cost, the end value, rental demand, monthly cash flow, the exit strategies, and your contingency budget. Listen, a low tax bill will not rescue a bad property deal. 3 mistakes almost all professionals make. 1. Assuming every rundown property qualifies for stamp duty. A property does not automatically qualify. Stop being residential simply because it's in poor condition. Ordinary disrepairs, outdated facilities, or the need for major refurbishment may not be enough to change stamp duty qualification. Mistake number 2, trusting refund companies promising easy money. But extremely careful with companies promising guaranteed or easy stamp duty refund. You see, I've witnessed investors have submitted claims based on questionable advice only to face challenges from HMRC later. You are ultimately responsible for ensuring the information submitted is correct. Mistake number 3, waiting until after completion to get advice. Do not wait until you've completed the purchase of the property before speaking to a specialist. Get advice from an experienced property solicitor and qualified tax advisor before exchanging contracts. The correct classification should be investigated and supported before you commit to purchase the property. Let me ask you a question. Imagine I offered you 2 properties. The first one is beautiful, fully renovated and ready for a tenant to move in tomorrow. The second is ugly, empty, boarded up and in need of major work. Which one has the potential to create more value? The answer may surprise you, because property investors are often rewarded by solving problems other people are unwilling or unable to solve. In essence, the bigger the problem you can solve safely and profitably, the more value you may be able to create. Some of the biggest opportunities in property are hidden behind boarded up windows, empty offices, and buildings that most people would immediately reject. Most people see risk, experienced investors look for potential. Comment below and tell me, would you rather buy a ready-made investment, or would you prefer to create value through a commercial conversion or derelict property project? If you like this video or any of my videos, smash the like button below, subscribe to my channel for more videos about property investment, cash flow, capital appreciation, financial freedom, passive income, and building long-term wealth through property. Because the biggest profit are rarely found in perfect properties. They are created by transforming imperfect ones. I look forward to sharing the next one.